All right. Good evening, everyone. Thank you for joining us tonight. My name is Matt Kopchak. I'm the Vice President of Operations with Worthross Management Company and would like to welcome you all to our October Speaker Series event. This will be our last event of 2021. So if you've been with us throughout the year, thank you. We'll have a new library of events coming forward for 2022, and we're excited to release those as we get more details prepared. So with that, I would like to remind everyone that we are recording tonight's session. So it will be available on our YouTube channel, and Nicole will distribute a link to the recording tomorrow or early next week. So with that, we're going to touch on the topic for tonight, which is Banking 101 for HOA loans. And with me, we have Jeff Barnett from CIT Bank. I'm going to pass it over to Jeff here in just a minute, but before I do, just a reminder of how the flow of this evening will go. So Jeff will be presenting for 35 to 45 minutes, and then after that, we will move into a question and answer session. So some questions have been submitted ahead of time, which we will cover, and then if anything comes up throughout the evening, feel free to chat those in to myself, or raise your hand when we're in the open session for Q&A, and we will let you ask your question live. So with that, I'm going to pass it over to Jeff to get started.
Thank you, Matt. I appreciate it. And I appreciate everyone's attendance. I know it's late in the day, so I'll try to keep things light and entertaining and informative. I am Jeff Barnett. I'm with the Community Association Bank, which is a division of CIT. My division of the bank specifically deals with homeowners associations, both on the banking side, practically handling deposits and payments and things like that. But what I do specifically is I am the director of lending. So I am that individual that assists associations and talks to boards in the event that they need to borrow money. And so a lot of times I'm showing up when things aren't going exactly as planned, or when something has occurred and the association is in need of some quick financing or some long-term financing to expand or improve the property. So that's my background. And aside from that, I've been in commercial banking for a little over 20 years. I've lived all over the country. I come to you from Denver, Colorado tonight. That's why I'm wearing a sweater, and you're probably all wearing t-shirts, but winter is upon us. So I'll look forward to seeing you all out here for ski season. I'll share my screen now so you can kind of walk through this presentation with me and some of the topics we're going to cover. As you can see on the screen, there's lots of things that have to do with homeowner associations and loans and dealing with the bank. And so I'm going to spend just a few minutes on each of these topics, and hopefully this creates some ideas in your head about how these apply to you as an association or what you might have coming up the road. I'm going to skip around on this list, so I'm not going to go in order, so I'll keep you on your toes. But let's start at the top and what it means to be bankable. When I talk to board members or managers, or when I speak at a town hall, oftentimes associations are concerned with how they might qualify or how they become bankable, or why on earth would a bank even loan an association any money? And I have to say, it is an unusual thing. Most banks like to deal with commercial loans where we take a lien on a house or a car or a building, and association loans aren't like that. And so becoming bankable as an association, to me, doesn't start the minute that I show up at the association. It starts years prior to that. And how an association becomes bankable is building an association that has a plan. And I know this is uncomfortable conversations because everyone always wants to hurry and talk about assessments and keeping assessments low. And that is part of a plan. But really an association becomes bankable when they have a plan. And a plan revolves around the landscaping and the painting and the water consumption and all of the other capital projects and expenses that are associated with an association. What I consider the foundation of a plan is become knowledgeable with the financial statements. And you don't have to be a math wizard or a banker like me to be comfortable with the financial statements. And for the benefit of the group, I'm going to go through what the financial statements are quickly. There are two that are important. There is an income statement and there is a balance sheet. And the two go together hand in hand and serve as the foundation for a good plan for the association to become bankable. So the income statement is where all the income shows up and where all the expenses go out. On the balance sheet is where you have long-term assets. It's things like cash, it's things like liabilities, and it's things like equity. So those two documents become the foundation for a solid plan. Now, a lot of associations will come to me and say, hey, Jeff, here's our income statement. How much can we borrow? And I set the income statement aside and I look at their balance sheet, because banks want to loan money on things that are long lasting. How much cash there is, how much equity there is, and how many liabilities the association has. And so think about that the next time you get your loan package, or pardon me, you get your package from your management company and it has a lot of information in it, and it may have copies of the financial statements. Take the time to look through those and become familiar with the income statement, and you'll see expenses on it. And then take a look at the balance sheet and see how those two things differ. To become bankable, what the bank wants to see is that what you take in minus what you spend equals something more than zero. So it's plus, minus, equals, and a number. That's what your income statement looks like. And so we want to see that there's something left over. A lot of associations don't want to have anything left over. They think that what we take in minus what we spend should be zero. And that's not being bankable for our bank or for any bank or for any of us personally. When we have money left over, that money flows over to the balance sheet and becomes a long-term asset. Those are the dollars that we can use to repair the roofs, to repair the sidewalks, to paint the buildings, to fix the asphalt. That's the money that is used for long-term capital projects. We're not simply paying the monthly utility bill with that money. We're planning for the future, and that's a plan. That's how you become bankable. So how you become bankable, remember, plus, minus, equals something greater than zero. It cannot be zero, because then you're not letting any of that money flow through to the balance sheet. So the next item, what does the bank consider before considering an HOA loan? Well, it has a foundation on what I just discussed. Does the association have a plan? Is the plan a 1-year plan, a 3-year plan, a 5-year plan, a 10-year plan? I know Worth Ross very well, excellent management company, and I know they are involved and engaged in planning. As board members, we have to embrace that. We can't just think about replacing the flowers or the monument sign every year, or how much money we're spending on water, keeping the grass green. Those things are important, but they're not really those solid components in building a long-term plan. So when I go into association and meet with the board, the first question they ask me is, Jeff, how much can we borrow? And the question I ask back is, tell me about your plan. And sometimes people scratch their heads or look down at their shoes because they have no idea what I'm talking about. But oftentimes they'll say, hey, we've got a 5-year plan. Let's go through it. And so we'll pull out the financial statements. We'll take a look and see how much money they've been setting aside for the roof or the paint or the roads. And oftentimes that might not be enough. So we can talk about a loan to make up the difference. So that's what the bank is looking at when we consider an HOA loan. It's just prudent financial planning that rests in a plan that the board 2 boards ago or 3 boards ago started. And now the current board is working on that and trying to project that into the future. And so that's kind of the foundation of what we look at. The next
Jeff,
thing.
can I ask a Can I make a clarify or ask a clarifying question here? When you say plan, that would be a reserve study would qualify as the plan you're referring to, correct?
Great observation, Matt. And yes, the reserve study is oftentimes the cornerstone of the plan,
Okay.
because I suppose when board members meet together, they look through the income statement and say, "Wow, that landscaping is really getting out of whack. Let's try to get that contract cheaper." And okay, we're going to raise assessments 2% this year because we need to costs are going up, so we need to do that. But when it comes to capital projects, how on earth do you know how much the roof is going to cost 10 years from now, or the paint job is going to cost 10 years from now when you have to do it? And so the reserve study is the cornerstone of that plan, because that way you can look at the reserve study, project out what expenses are going to be to repair those capital projects, and then layer that back into what the plan is and how you're going to accumulate that much cash. Does that make sense?
Yes, thank you.
Okay. All right. So let's talk about association loans now, because if there is a plan, oftentimes there is not enough money to meet every obligation. I haven't run into really any associations that are 100% funded for all their capital obligations, because assessments would have to go up pretty quickly every year because the costs of improvements are going up so dramatically, especially down there in Texas. I think I've heard say that labor costs and the cost of lumber and asphalt related materials down there have gone up in the hundreds of percent over the last 12 months. So I empathize with those situations. And so sometimes, even though you've been saving and you have a plan, the association may not have the money to do the capital project. And so how does that, impact the community? Well, I will say that many years ago, borrowing money was frowned upon. It was frowned upon for everybody. The only loan you would ever take out on a personal side would be your house loan. And on the commercial side, unless you were building a large multifamily project, most associations would save, and until they had the money, they wouldn't repair it. But as times have changed, I think associations, like most commercial entities, have realized it's prudent to borrow as long as you can get good money. And I'm a banker, and so I've got a pretty good impression of what good money is, and good money is borrowing it cheap and locking that rate in for a long time. And so over the years, especially this last 12 to 15 years, interest rates have been very low. So we've seen a large expansion in homeowners associations borrowing money, because honestly, the amount of money that you can borrow and lock in a rate is almost what you can get when you're putting it in the bank during certain times over the last 15 years. You can almost get that much in interest. And so how does the borrowing money impact the community? It's almost the prudent thing to do, because as you can repair things and as you can keep the community in good standing and aesthetically appealing, the community will continue to improve in value, and that loan will have a fixed rate that's manageable by the association dues. The question that I often get is, Jeff, we're going to save, and we're going to save and save and save. We'd prefer to do that versus borrowing any money because we don't like to pay interest. And honestly, I know this probably isn't going to sound right coming from a banker, but you're right. Borrowing money costs money. If the bank gives it to you, we want it back, and we want interest to come back with that money. If you use your own money, there's no interest. And so that is the better thing to do, is to use your own money versus our money. But like I said previously, oftentimes that's just not possible. You can't have leaky roofs and say, okay, we'll have the money to fix that roof 7 years from now. The converse argument to that is that for associations that have multiple buildings, oftentimes boards will say, well, we're going to do building 1 this year and building 2 next year, and 15 years from now, we're going to hit building 15, and then we're going to circle back and do building 1 again because that roof will be all worn out by that time. I call this the grandma's quilt approach, because what the community will look like is grandma's quilt. And let me explain what that means. That first roof that you did 5 years from now is going to look like the first square in grandma's quilt that the dog sat on and that got something spilled on it and that has a couple tears in it. And the fifth roof that got done is going to look like the brand new one that grandma just put in. And so you're going to have all these differentiating colors and textures. Asphalt is going to be different color. Roofing is going to be different color. You might not, roofing material goes out of production. And so some roofs may even have a different material than other roofs. It's not consistent. And I know all of us have driven by communities that look like that. And so what I have found, both on a borrowing money basis, on a aesthetic basis, and is on a real estate value basis, when you can combine and do all the work at once and everything is uniform and consistent, aesthetically and financially, it has a longer term value than trying to piecemeal projects together over time. Of course, I'm sure there's 10 people out of 20 here that would like to argue that with me, and I totally understand. I get it. Again, I understand paying interest is something that is not good for an association, but I would argue that getting projects all done at the same time has a greater return to residents than trying to piecemeal them together in little pieces. And how does this affect residents when you borrow money? So I talked a little bit about how it looks in the community. Now, as far as residents go, when boards plan for assessments, for capital projects, and for borrowing, what I like to tell them to focus on is you're not focusing necessarily on the community as a whole, but you are focusing on each of the individual residents because each individual resident's financial position is different. You have people that have lived in your communities since they were built, and you have people that just moved in. So everyone's financial position is different, especially through this pandemic. Everyone's been in a different work environment and a work situation. So it really does have an impact on what people can afford. And so when I meet with boards and they say, "Hey, Jeff, we want to do these 15 projects and it's going to be $5 million," and I'll say, "Okay, well, how many residents are there?" And they'll say, "Well, we've got 25 residents." And I'll say, "Okay, have you done the math? $5 million divided by 25 people, what's that going to mean?" And then everyone starts to scratch their heads and say, "Oh my goodness, that's a lot of money. I don't know whether we can afford that." And so you really got to consider, and that's part of your plan, is the projects that you've got planned, what's the financial impact to residents on a monthly basis or an annual basis? That's why loans can be such a valuable tool, because when we can take a large project, even though it may be the $5 million project, and spread that out over a period of time, oftentimes it means that residents don't have that huge financial hit every month in their budget. And so whether they moved in a week ago or 10 years ago, it gives them the option of kind of planning out how they're going to tackle their portion of the project. So I have seen in my experience, and I will tell you, I've done thousands of HOA loans all across the country, that's received very well by residents. When they can get improvements done, the community looks better, values of properties are either stable or enhanced, and it's their choice on how they want to meet their portion of the obligation. I've found that it impacts residents in a favorable way when there's choices and options. So the steps in the process of getting a loan to how a loan is paid back, just like any loan, the association makes an application to the bank. And I've worked with many Worth Ross managers who are excellent in assisting in this effort and guiding boards through this effort. The bank has an application and we get supporting documents. Now, this isn't like getting a personal loan. Remember, this is a commercial loan. So the bank kind of looks at things a little bit differently. We're not getting individual tax returns from residents because honestly, we're not caring about individual residents' financial position. We're loaning the money to your corporation. And so the corporation fills out an application and then we take financials from the corporation. The key document that the bank zeroes in on is the aging report. Now, remember, I told you we don't put liens on real estate. So one of the things that the bank looks at closely is how residents are paying their assessments and if they're paying them on time. And so you can consider when you're looking at your financial statements, you look at the balance sheet and you look at the receivable line item and how much is in there. And those receivables are dues that people haven't paid because the association is waiting to receive them. And so what the bank wants to see is that residents are paying and they're paying on time. That's one of the benchmarks of our loan program because we're taking assessments as collateral. And so we want to see that residents are paying, and if they're not paying, the association is pursuing that money and collecting it as quickly as they can. So an application along with supporting documents, and one of those documents is a receivable report. When the bank gets that, we do underwriting. And I'll talk about a couple of our loan products in just a few minutes, but underwriting can take a day or it can take up to 10 days. So this isn't something that's drawn out that associations need to plan 6 months in advance because the bank's going to take so long to get all this underwriting done. It's really very simple. And I'll deputize everybody on the phone right now to be a loan underwriter. And I think this is going to sound familiar to you. What the bank looks at in underwriting is plus, minus, equals, greater than 0. So it's easy. We want to see that the association is collecting assessments, that they're spending their money prudently and making increases in assessments or dues when necessary, and that they're contributing to reserves. So that bottom number greater than 0. As long as the association is doing that, we project out the liquidity needs for the future, and typically we can give an approval on a loan. So underwriting is not difficult. Anybody can do it. We do it better than anybody, but it doesn't take a long time. After we do the underwriting, the bank makes a decision and then the loan is closed. Sometimes the loan dollars are fully funded the association. Sometimes the association draws down on the loan and then it amortizes once the work is done. And I'll talk a bit more about that in a couple minutes. So the steps to get the loan to the payback are easy. You apply, provide some supporting documents, the bank underwrites it, we make a decision and close on it, and then the loan is paid back over time. One important thing to consider when it comes to the loan payback is that these are fully amortizing loans. There isn't any balloon payment and there isn't any adjustable rates when it comes to the loans. Your associations are not-for-profit organizations. So the only way you generate money to pay the loan back or to pay anything is by reaching into everybody's pocket. So if we can maintain some consistency when it comes to the needs of the association, that is positive. What the bank has done is we've set fixed rates on all the loans. So that way there aren't variable rates. Think about 2006 and 2007 when everyone was going out and getting a home loan, that was an adjustable rate. As soon as the interest rates went crazy, everyone's interest rate went from 2% to 8% and everyone freaked out. We don't want that. We don't do loans like that. And so the association has a predictable scheduled payback that amortizes over a fixed amount of time. How much will an HOA loan cost? That's probably the most popular question I get. Well, I work for a bank, and so interest is how we make money. Aside from the interest that the association pays back, there really aren't a lot of costs to an HOA loan. The most fundamental part of getting an HOA loan is free, and I'm going to tell you what that is, talking about it. I have talked to boards a year or 2 years before they've ever come back to me needing to get capital projects done using financing. So I would encourage you to consider, have a conversation with your property manager and then invite a banker, invite me, Olivia's there in your market, to have a conversation. Talking is free. And a lot of boards will have a conversation with me or somebody who's financially literate or wants an outside opinion just to talk about the plan. And I've done that lots of times. I'll go through a 3, 5, or 7-year plan with the association and we'll talk about liquidity and capital projects. Oftentimes that leads to those associations coming back to me in 3 years and saying, Jeff, we've stuck to the plan. We've raised our dues and assessments, and now we're going to do all of our roofs and we need a loan for $500,000. Great. All the things are in place for them to be successful and get the work done as needed. So that's the most important thing to do, and that part is free. How much a loan costs? Well, there's interest associated with that, and I'll talk about interest rates here in a second. There are bad sides of a loan, and I'm going to talk about those two things right now. They're down at the bottom there. What if residents don't pay their portion? And what if the association does not pay back? Well, in reality, this is a loan. And so like all loans, the association has the right to not pay, I suppose, and the bank has the right to foreclose. So if residents don't pay their portion, that part is up to the association. So just like today, if a resident decides that they don't want to pay their monthly dues or their monthly assessments, however you refer to them, then the board, under the bylaws and the declarations that you have rights to pursue action against that individual. And as a corporation, you take those steps, those legal steps, to go and try to get the money from that person. That's exactly what the bank does. We expect the association to follow their collection guidelines. And then if the association is doing that, typically they'll have the funds to pay the loan back. But if they decide that they no longer want to pay the loan, or something traumatic has happened that they can't pay the loan, then the bank will foreclose. And we foreclose on the corporation, not on any individual. So we can't take houses away or take your pool away or your clubhouse. We can't do that. But what we can do is take the assessments, and those assessments come to the bank. We take our payment out, and then we remit the rest of the money back to the association. So we don't take over the board. We don't come and rename the community CIT. We don't do that. We can't do that. But what we can do is foreclose on the cash the association has. Now, I will tell you, we've never done that, but it's possible. So those are the kind of negative parts of what can happen in a loan. Okay, so that was a lot there. Let's talk about a few of the projects that we've done down there in Texas. You can see them here. We've hidden the names to protect the innocent. But you can see a lot of different associations here that had lots of different needs. There's high rises, there's condominiums. We've even done a lot of single family home financing down in Texas, where associations want to do new splash pads. They want to update their clubhouse. They don't have a clubhouse. They want to put a clubhouse in. What I'm hoping you're getting from looking at this list is that it doesn't matter what the association is made of. It doesn't matter if it's a high rise, like that first one, 13 floors, 111 units, $1,680,000, or a smaller, a mid-rise condo, or any combination of different types of low-rise, high-rise, single-family homes. Associations can borrow money from the bank for any project as long as it's for the benefit of the association. So everything that I've just named, we can do. If you want to put a new roof, you want to put new glass windows in, you want to do facade work, new clubhouse, new pool, new splash pad, new irrigation, new landscaping, repairs on any of those things, we can do any of that. So hopefully you can see something on this list that might ring a bell with you, and you can see that dollar amounts vary greatly. The reason why this is pretty important. A lot of associations have planned, but simply fall short. And so the bank can work with the association if they've got some money, they want to borrow some money, and then they're going to use assessments to pay the rest. Excellent, no problem there. The bank doesn't require, if it's $1 million project, that you must take $1 million of our money and you can't use any of yours. That's not the way it works. So if the association has some funds set aside for a roof project, and then wants to use some bank dollars, and then wants to use assessments or a special assessment to repay, that's terrific. No problem there. And so you can see a lot of different examples here, and hopefully that gives you some understanding of what projects look like and how the bank can really be flexible in offering basically a loan product that can suit just about any circumstance.
Jeff, can I interject for 1 second on that
Sure.
comment you just had on this slide? You used the phrase down payment. So, in my experience, obviously we hear that a lot in consumer lending, but
Yeah.
in this arena, commercial lending, HOA, I have not heard that. So can you elaborate a little bit on what that looks like?
Yeah, and forgive me if I use that incorrectly, if that's the impression that you got, because the bank will finance 100% of the project and there isn't any down payment needed. A lot of associations will consider reserve dollars that they have set aside as a down payment on the project. And so if I use that, that was
Okay,
the purpose of using that term.
I
And
might have
so
misunderstood.
associations, yeah, no, I'm sorry. So yeah, there is no need for a down payment, the association does not have to put any cash into a project. We can finance 100% of the hard costs and soft costs. So engineering, permit, any fees associated with the project, as well as the hard costs for construction. Um, if there were to be such thing as a down payment, then that would just be any liquidity the association has set aside as part of that project. Okay.
Thank you.
Uh-huh. All right. So we've got a couple different loan products. We've got a quick term loan and we've got a standard loan. Our quick term loan, you can see some of the highlights there. And I will say that over the last 12 to 16 months, the quick term loan has been unbelievably popular. What this is, it's a loan program that goes up to $3 million. You can see you can choose your term there. The fees are very low. It's only $500. But this quick term loan is meant for associations that fit within a particular guideline set. So the bank has got about 7 prerequisites. And the most important one of those prerequisites is that delinquencies on a community basis are less than 8%. And let me talk about that for just a second. So as I mentioned before, delinquencies are important to the bank, and that's one of the cornerstones of underwriting. So for the quick term loan, delinquencies have to be under 8%. So how the bank counts delinquencies are on a per unit basis, not on a dollar basis, on a per unit basis. And the number of units can't be greater than 8% of the total. And we count delinquencies as those units that are past due for more than 60 days for assessments only. So if someone has gotten a fine because they put an Easter egg flag out on their condo and they got a $20 fine and they're not paying it, we don't care about that. I mean, I care because it is an Easter egg flag and, I can't believe that, but we don't care about it as far as past dues are concerned. Okay. So when you think about, if you're a board member and you're thinking again about the financial statements that I kind of referenced and beat up earlier, and you look at that receivable line item and you say, wow, we've got $30,000 in receivable, but that's from unit 100 and no one else is past due, then I only count one. I don't count the $30,000. Okay. So think about your number of units, and no more than 8% of those units can be past due, 60 days or more past due, to qualify for the quick term loan. Now, the qualifications on the quick term, basically what the bank is looking at is the number of units, the average annual dues per unit, and then we come up with a number that we say, based on the information you've given, you qualify, but up to this dollar amount. So like I said before, the quick term loan, very popular, and it can provide those smaller dollar items. Hey, we need a quick asphalt repave, or we've got some leaks that we didn't plan for. We need $150,000 or $1 million. Great, quick term loan can be good. Now our standard loan is that more traditional loan, takes a little longer to underwrite. There's a few more fees associated with that. It can go up to 15 years. And I'd love to do a loan for $25 million. So hopefully someone on this call has got a big one out there and you can call me straight afterwards, because we can go up to 25 million. If it's less than that, or let's say your delinquencies are higher than 8% of your total number of residents, well, that standard loan then is going to be a better product. Our standard loan delinquency can go up to 10%. So just to make the math easy, if you've got 100 units, then 10 can be past due 60 days or more. then that would be the right product. The standard loan is just exactly what it is. It's kind of our down the fairway for associations that may have some litigation lingering out there, may have a few more delinquencies, may have a little larger project and want to stretch it out for a little longer. Keep in mind what I mentioned previously. As board members, you hear from your property managers, prudent financial planning. I have associations that come to me and say, Jeff, we need to do some painting on our buildings, and there's 3 of them, and we want to paint them, and we'd like a 15-year loan. And I say, I'm not doing it. And they say, well, why, Jeff? Why? And I say, well, because you're going to come back to me 6 years from now when you're still paying me back, and you're going to ask for another loan to repaint your buildings. And how do you think residents are going to feel when they're paying for paint and they're borrowing for paint? That's not prudent financial planning. And so what the bank does, and what I would encourage you to consider when you're thinking about borrowing for capital projects, is the life of the project. So obviously, if you're putting a roof on, you expect that to last 20 years or more. So it would be reasonable to do a 15-year loan. When you're doing painting, maybe we only want 5 years on that because we don't want to be paying when we're redoing it. So think about how long that capital improvement will last, and that might match the amount of years that you want the repayment to be. So we've got a quick term loan and a standard loan. Both options are available. Okay, so I think I'm just about on time. You can see my contact information up there. I've covered a lot of information, but what I hope that you might remember, let me hit a couple highlights of what I've gone over today. First, a conversation is free. And I think that's the most prudent part of creating a financial plan. Work with your on-site manager or your property manager. There's a lot of expertise there. Work with a banker. I am an example of a banker. Olivia is also, and we can help give you feedback, third-party feedback on what you're planning. And if you've got a project looming on the horizon, whether it be a month away or 6 months away, it's free to have a conversation and discuss options and decide what might work best for your organization. Next thing, the bank can create loan programs that are really flexible. It doesn't matter if you've got roofs or pools or anything else that you've got, as long as it's for the benefit of the association. Typically, the bank can create a loan program that matches what your community's needs are. But that starts with the conversation. And then last thing, I just want to reiterate, prudent financial planning oftentimes leads to success. I know a lot of associations, the first thing I do when I go to meet the board, everyone is congratulating themselves on not having raised assessments for the last 27 years. And we all know that stuff costs more money. And so looking at your income statement and your balance sheet, understanding how those 2 documents can be the good, solid foundation for a plan for the future may also include assessments and understanding how assessments might be modified year to year to ensure the association has liquidity to meet their obligations for the future. Okay, that's all I had prepared. Matt, I'll hand the conch back to you.
Thanks, Jeff. This was great and very informative. And I think you've touched on most of the questions asked in advance, but I want to go back to a couple of them and see if maybe you can help create a little bit more clarity around a couple of these. So in terms of an association preparing for a loan, you touched on kind of the threshold, or more or less, that you're looking for when it comes to delinquency and cash on hand. So the question is kind of twofold. Could you reiterate what the criteria that the bank is looking for as it relates to collateral? And then the second phase of that, you had mentioned that delinquency, at least is how I kind of interpret it, was the delinquency the bank is looking at is based on volume, like number of units, not a dollar amount. So in other words, if you have 100 units out of a 500 unit community that are delinquent, that might be an issue in the eyes of the bank. But if you have 2 units in a 100 unit condo, but their balance owed is $100,000, that's not as big of a concern. So 2 questions, and I can repeat if you didn't follow all of that.
No, I think I got it. Thank you. Two great questions. Thank you. And this is worthy of qualifying for further discussion. So firstly, cash. So when the bank considers an association and their cash position, obviously, if the association has the money to do the project, they wouldn't be calling Jeff Barnett to loan them the money. So the bank doesn't say, okay, you have a project for $350,000. How much in reserves do you have? Because it better be $349,000. Otherwise, we won't loan you the money. That would be great, but that's not exactly how it works.
Okay.
What the bank wants to see kind of revolves around that plus minus equals number that I talked about. Obviously, we want to see that the association has something in reserves because that illustrates that they're contributing to liquidity for the future. But what the bank really zeroes in on is how they're going to service the debt. And so let me give an example. So if we look at the income statement and the association brings in 100,000 and spends 100,000 on landscaping and utilities and everything else that's normal operational costs, and they want to borrow 100,000 from me, my first question is going to be, well, how do you plan to repay? Because there's nothing left over. There's zero. And so the first part of the conversation is what is left over to service debt? And that can be a combination of reserve dollars that are being contributed to reserves currently, or an increase in assessments or a special assessment. So obviously that question oftentimes answers itself. The bank isn't zeroing in on, okay, if you're going to borrow 300,000, we need to see you have 300,000. What the bank is zeroing in on is how can you handle debt service on a monthly basis, and what are you still contributing to reserves? Because we can't, and you don't want, any association doesn't want to come to the bank to borrow 100,000 today, and the next year come to the bank to borrow another 100,000. That doesn't make any sense. So that constant revolver of borrowing can be avoided by saying, okay, we've got money left over on an annual basis to service debt, and we're still contributing 5% or more to our reserves so we can meet future liquidity requirements. Okay, so that's the cash part of it. The other part is you answered it correctly. So if you've got an association, the bank looks at two thresholds for delinquencies. Our quick term loan is 8% and our standard loan is 10%. And so yes, it's by resident. Because remember, the way your corporations function is on a cash flow basis. If you have 100% of your residents paying their assessments every month on time, then you are cash flowing at 100%. For every resident that doesn't pay, you're cash flowing at an incrementally lower amount. And so what the bank wants to see and expects is that you're operating at no less than 92% or 90% of your cash flow opportunity. So that is by a per resident basis. Because the reality of it is if you do have that example that you gave, we've got 100 units and one of them is past due for $100,000. The reality of it is you probably won't collect that. And it's humorous to me to see associations who have receivable balances from 7 years ago, and 10 people are on there and they've all moved out of the community and they're still holding on to those receivables as if they're going to collect them. You know, the bank understands that may or may not be collected, and that's really not part of the cash flow that's going to service the debt. So that's why we look on a per unit basis and we only look at dues or assessments, because that is the foundation of the cash flow your companies generate in order to service monthly obligations as well as service debt to the bank. Good?
Okay. That's perfect. Yes, thank you. So this kind of builds off of the question or the answers you just provided. This was submitted in advance. So for associations that do not meet the criteria, I'm rephrasing a little bit, the associations that do not meet the plus minus criteria you identified or exceed the receivables number you're looking for, percentage you're looking for, are there other options for associations to secure a loan?
No.
Okay.
And that's, I don't want to be, I'm sorry to be blunt, but I believe it's prudent to be direct. And that's where that conversation comes into play, because many associations I meet are at 12% or 13 or 14%. Now you've got a funny thing down in Texas where you will put residents on payment plans. And that's a topic of discussion with the bank because from a bank standpoint, they didn't pay their assessment when it was due, so they're past due, even though they're paying on a payment plan. And so we can talk about that. And oftentimes the bank can work with associations that have a lot of residents in that situation. But the reality of it is the first thing that I'm going to ask is why aren't they paying? Are you following your collection policy? And why aren't you collecting the money? If there's a systemic problem, then you don't want to borrow money from the bank because we want it paid back. And if you can't meet those obligations, we don't want to put the association in further financial stress by having debt to service and operational expenses to service, and you're not collecting your cash on time. And so
Okay.
that protects both of us, the association and the bank.
Okay. That's great. Thank you. Is it difficult for an association to obtain a loan if a lien has been filed against the association? Does that impact it?
You know, I'm trying to think, and maybe Nicole or Matt, maybe you can come up with an example, but the only liens that I know that can be placed against an association is if they've pledged their assessments to somebody as collateral for something. And so that's the only time. What the bank files is a UCC filing against the association, which shows up as a UCC filing. So we essentially have a lien against the association's cash. That's what banks do. So if an association has gotten a line of credit somewhere along the line or something like that, if there's a lien, then yes, that'd be a problem for us because we want to be the only bank. There can only be one lien, and that needs to be our bank in that situation.
Yeah, the question doesn't specify the type of lien, but I would assume it's like a guess it would be classified as like a mechanical lien. Maybe a vendor contractor didn't pay a
Yeah.
subcontractor, and so I don't know if that would impact it or not.
Yeah, that'd be the same thing because obviously there's a financial situation out there. And honestly, the only time I've ever run into that, if there was a mechanics lien out there for work that was done at the property and a roofer or a painter or somebody filed a mechanics lien, that usually turns into litigation.
Yeah.
And so we can deal with that if it's a known thing, like it's being pursued by the insurance company or something like that. That would disqualify the association for the quick term loan. But a standard loan, we can oftentimes look at that. And as long as we can predict what the expenses are to the association, we can typically work with that.
Okay. The approval timeline on the standard loan, what does that look like in most cases? I'm sure no two loans are the same, but
Yeah.
in terms of application submission to funding, is it
Yeah.
weeks, months?
Yeah, let me go back to this. So this screen kind of outlines that. So it's taking us about 10 days to decision a standard loan. After we decision a loan, we send out a commitment letter that says, these are the terms under which we're making a commitment to lend. If you agree with that, you sign it, you send it back. And then there's other documentation that the bank asks for to create loan documents. Once we have that, we close the loan. It varies greatly from association to association how long it takes to close a loan.
Okay.
I've had quick term loans close in 2 weeks, and I've had quick term loans closed in 6 months. So it really is once the bank makes a decision, and I think that's the important part. You know, if an association comes to me and says, Jeff, we want to put shovels in the ground in February, when should we apply? And I'll say, okay, well, let's work back from February because it's only going to take us 3 days on a quick term loan or 10 days on a standard loan to make a decision. After that, it's kind of up to you and how quickly you respond to the bank with the documentation needed to present loan documents. And so I think that's something, Matt, honestly, we can talk to the manager and the board about and build a plan. We usually work backwards from the day work is going to start.
Okay, perfect.
Mm-hmm.
Let's see. So question was chatted in. The current market rate, current rate market. Sorry.
Yeah. Let me give you some rates for our quick term loan. and these are set. Our standard loan, those rates vary depending on the size of the loan and the term. But our quick term loan has published rates today of 3.85% for 5-year money, 3.95% for 7-year money, and 4% for 10-year money. Remember, those are all fixed rates. And so I'd say that's a good gauge to determine where our rate's at. Now, I will say that our rates are based off of the Treasury, the US Treasury, and that's been in the news a lot lately. Everyone's a junior economist now because everyone's talking about the US Treasury bills and everyone wants to pontificate about it. I'll be a banker right now and put my banker hat on and say rates are going up. And in the banker's world, hopefully rates are always going up. But the 10-year money, 10-year US Treasury now is in the over 1.6. The predictions I read by the end of the year, it'll be in the 1.7s. So rates are going up marginally, but today, if you were to apply for a quick term loan, you'd get 3.85, 3.95, or 4. So hopefully that's a good guide.
Okay, great. Thank you. Next question that was submitted, should board members be working directly with the bank, or should we allow the management company to work with the bank?
That's a great question. I think that personally, I want to talk to the board, and that's typically facilitated by the manager because the manager has keen insight to the market and the financial position of the association. So I'm usually invited in by the manager and the board, and we sit down and have a conversation. The manager is going to help facilitate the acquisition of the documents the bank needs and give guidance. And then the bank obviously is going to do the banker part, and that's the underwriting and the documentation for the loan. And so it is not a one or the other situation, especially when it comes to the expertise that Worth Ross represents. I think for all the loans that I've done for properties managed by Worth Ross, it's always been a combination of manager, banker, and board.
Perfect. Okay. This might be the last question we have. It's kind of an odd one, but in my experience, there's been situations where developer might retain a unit, or the association, and as a result, the association might be using it as office space, or the developer might retain a common space to be sold off later in some way, shape, or form. So in those instances, let's just use a unit as an example. Does the bank offer a mortgage option for an association, or would it all be through the products you had discussed tonight?
It'd be all through the products we have discussed tonight. And so that's the only option we have.
Yeah.
And I will say that if the association wants to purchase a unit that the developer is selling and they want to retain that unit for office space, and they want to amortize it over 5 to 15 years, then I've had associations that will use our funds to do that. If they want to use it for a rental, oftentimes they'll go get a mortgage on it versus using our commercial dollars, because obviously a mortgage lasts longer and is a little cheaper, because it's spread out over 30 years. Now, from my perspective down there in Texas, what I run into more often is less times a unit, and it's more time a common area element that the developer retains and wants to sell back to the community. So a clubhouse or some sort of playground or a lot, that's the most popular one. Those dollars are very often used using our dollars because the association plans on doing something with it. Either it's going to stay a clubhouse, or they're going to put a playground on an empty lot, or they just simply want to retain the lot against purchase by some commercial entity that they would prefer not to have in that community. So let's say they don't want a gas station on their corner, so they'll buy an empty lot on the corner, so the developer won't sell it to a gas station. They want it to be a park instead. So that's up to the board, and certainly I'll give quick feedback on those types of acquisitions, whenever I can.
Okay, perfect. Well, it looks like we're a few minutes early, but there's no more questions. And so with that, if you don't have anything else, Jeff, we can log off for the evening.
No, I really appreciate the time. I wish everybody much success. I hope everybody is well, and I appreciate the invitation.
Well, thank you, Jeff, and thank you, Nicole, and we will see everybody again soon.
Okay, bye-bye.
Bye-bye.